I mean, you hit on the important thing, and one thing I said this year. So I did believe stablecoin would be the big thing this year. I'm very surprised Bitcoin's only up, whatever it is, 18% year to date, but stablecoins have been the reality check for everyone in understanding, and it was because of the network effects.
There's obviously a geopolitics game that finally is getting played in South America, which is like, we need all of this as part of our center of sphere of influence. The other thing that's interesting, because we were talking about Circle and its IPO and the network effects, stablecoins are now network effects on the US dollar. You've made it a digital network layer, which can be built on instantaneously at scale by anybody permissionlessly.
The Fed didn't break the economy, exponential innovation did. Jordi Visser argues that the defining story of 2025 has nothing to do with inflation or a Fed mistake. In his view, this is the year exponential innovation finally crashes into the labor market. AI-driven productivity is beginning to replace knowledge workers, creating a structural shift that is only just starting to show up in employment data and earnings. At the same time, Visser connects this disruption to crypto markets, where a long overhang of venture-backed capital in SaaS and digital assets has been unwinding. Ethereum, Solana, and now Bitcoin have gone through forced selling as capital exits, but with PMIs turning and the Fed cutting, he believes the supply flush is nearly finished. Raoul Pal approaches the same period through the business cycle lens. He no longer believes traditional recessions occur the way people expect. Instead, he sees brief liquidity slowdowns without deep collapses. For him, the next cooling period likely arrives in late 2026 or into 2027, like 2012 to 2013 when markets dipped modestly, moved sideways, and then ripped higher. Pal's real concern is not a downturn, but what comes after it, an explosive, technology-driven bubble fueled by liquidity, innovation, and global capital flows. Their views converge on the same outcome, an era where AI adoption, falling labor intensity, and digital financial systems push markets into a powerful expansion phase. Visser sees crypto benefiting as the supply overhang disappears and digital dollars reshape global capital movement, while Pal sees the macro structure setting up for an extraordinary bull run into 2030. Different frameworks, innovation and labor for Visser, business cycles and liquidity for Pal, but both point toward a world where technology accelerates asset prices and transforms the financial landscape. If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying attention. We're here to keep bringing you sharp analysis and voices that understand what's unfolding. Thanks for watching.
Here, let's do it this way. I'll just give you kind of my my latest things that I'm writing about, which I think are the most important. So the Fed, let's say, pivots towards worrying about labor, and that happens in August at Jackson Hole. And you get all the cries from people that are worried about inflation and the cries from people that believe the Fed is making a policy mistake. And I think you and I are both, in this point of that eventually labor is going to be disrupted by exponential innovation. And I've written two pieces this week specifically on the fact that it's here, it's now. And as we leave 2025, the number one most important thing for people is this year was a transition year where inference started to accelerate in terms of token usage, which leads us into the next stage of artificial intelligence, which I've called stage 2, where stage 1 was where these machines and these bots went through undergrad and they've graduated. They have 160 IQ now. And that number is only going to continue to compound every month and as every release comes out. But that just means we're closer and closer to knowledge workers being disrupted, and knowledge workers make up a huge percentage of obviously the United States labor. And that's going to start in much bigger fold this year. And the problem is you've already seen Walmart. Now you've seen Amazon make the headlines. You've seen Accenture, 3 of the 4 biggest private employers in the country, have all said, we're not going to be hiring. We'll hire eventually, but they've openly said that they're not hiring. And I'll just bring this up because I highlighted this chart last week, which is if you have a long-term chart of earnings per share and you overlay it with 2 separate labor indicators, one just temp employees hired, temps have been going down consistently now, really since 2022. Exactly right around the point that ChatGPT got launched. And then secondly is just the JOLTS number, which obviously went up dramatically during COVID, but has come back down. But those two things were very, very much correlated almost exactly to earnings per share in the S&P. So we've entered that very dangerous point where, especially from the big companies like Amazon who are spending lots of money, they need to be reducing employees to stay competitive. And I think one of the mistakes people have made is that they actually believe, number one, AI is not going to do that. That's a mistake. Well, you and I both know that. Number two, they kind of view it as, well, the companies are not going to fire the people. And the reality is, in a capitalist world where your shareholders determine and your board determines what you're doing, you are absolutely going to see profit margins be the way that people are going to focus on. And I think we're at that inflection point right now where this labor situation, which has reached levels unprecedented, where you could have nominal GDP growing at 5% and no creation of jobs outside of healthcare. And I don't think we appreciate how when AI came in late 2022, that was also an incredibly disruptive force. And the reason it was disruptive and how crypto and the VC world are aligned, if SaaS, those investments in SaaS don't come back, then they have a lot of money trapped in crypto already and in SaaS. And I believe that this has been an overhang that reminds me a lot coming out of the dot-com bubble, which took a long time to get out. And this overhang that's felt shows up in supply. What Bitcoin's going through at this point this year, we saw in Ethereum earlier in the year. We saw in Solana. There was just a lot of supply that had to have been investors and people that own businesses and things that still needed to liquidate in something. And only now do I think, between the PMIs and the Fed cutting rates, that we're actually going to see that go up. I think on the crypto side,
Yeah, I mean, how I frame this is, look, there is a cycle, a business cycle. You got me to that point where I too don't believe there's recessions. I don't think they're possible. Which is still very contentious to most people, but there's a lot of thought behind that. That's not just a statement, put from thin air. And so we do get some liquidity slowdown, business cycle slowdown, and that happens in, let's say, 27 mainly, whenever it is, end of 26, 27. The next cycle, I don't think the drawdowns will be big. It's like 2012, 2013. Your kind of NASDAQ fell like 20% or so, went sideways for 6 months and then took off like a fucking rocket ship.
Yep.
That's what I fear is about to happen. That we're about to go into a full, spectacular, beautiful bubble. But next time around, into 2030 is going to be something quite spectacular.
Jordi Visser argues that 2025 wasn't a Bitcoin story at all. It was the year stablecoins proved the world was ready for a digital financial system. Network effects have made them unstoppable. Once people move money into this ecosystem, they never take it back out. His casino analogy captures it perfectly. Everyone may be used to the old financial system, but the new one is cleaner, faster, and better in every way. And in emerging markets, stablecoins are becoming a lifeline. Money that used to be trapped by capital controls can now exit in seconds. That's why he thinks much of the recent Bitcoin selling came from China, miners, family offices, and large holders as the state tries to clamp down before that escape valve grows even bigger. Raoul Pal takes the idea further, saying this isn't just finance, it's geopolitics. The US is now treating South America like a digital sphere of influence, and stablecoins are doing the heavy lifting. Circle's growth and upcoming IPO show that the dollar has evolved from paper into a permissionless, global network layer. Anyone in the world can build on it, transfer wealth through it, or store value in it instantly. And once that infrastructure is in place, it scales faster than any traditional banking system can compete with. Let's get back to the interview.
Rockets up in value, and everyone's like, what the fuck? How can a money market fund business essentially be trading at this? And I'm like, I've seen this before, and I'm like, there's one of two answers. Either it's a massive bubble in Circle and every retail wants to buy it and everyone's got it wrong, or none of us understand, but this is a network stock, because as we know, Metcalfe's law values things very differently, and most things are network stocks nowadays. And then we saw that announcement yesterday. They've got like a gazillion partners building on top of a network. I'm like, well, there you go. Because everybody tries to value this stuff via cash flows. and it's the wrong way of doing it.
I mean, you hit on the important thing, and one thing I said this year. So I did believe stablecoin would be the big thing this year. I'm very surprised Bitcoin's only up, whatever it is, 18% year to date, but stablecoins have been the reality check for everyone in understanding, and it was because of the network effects. You can't actually grow, and the visual or the analogy I've tried to give to people is, let's assume there's two casinos right across the street from them. One of them is this old, like, rotted down one, but it's the one you go to all the time, and it's the one you're familiar with. You know everyone in the place. And you're a boomer going into that casino, and that casino has most of the money. And then across the street is this very shiny casino, brand new, you don't know anyone though. So it's scary. But once you go over one time and you play in that casino, you're never going back to the old one. And that's what the digital economy is, and that's what the network effects are. The network effects will allow wallets to be open easier. And once the wallet's open and your money's in there, I've asked people the same question. Hey, the money you've brought into crypto or the digital economy, have you ever brought it back? No. Nobody ever brings it back.
No.
And that's why I keep saying it's like, you can have two casinos, you can be gambling in both, but at some point when the other one's all old and rotted and it's just not fun, you just move over to the one that's young and shiny and everything's better. And maybe it takes everyone dying before the money moves over and you hand it to the kids and they're already over there, but it's happening. And I think what Circle and all of these things are is they're getting more financial volume going through this system. And once more money is in there, we're not going to get to talk about this way, but this is another macro thing we could have talked about, and I don't know what your view is on this. I was very interested to see what happened with Malay this weekend. And the reason was...
Yeah, how did you read that?
Well, the way I read it was this. It was a very interesting thing that the administration basically said, we'll give you $20 billion. They're trying to impact the election. They're trying to get the voters to go, that you have the U.S. help. Now, if it didn't work out, everyone who is a local is going to take their money and put it into dollar stable coins. So the money's coming back in the U.S. Either way, the U.S. wins in this. So by using the swap, and I believe 100% that this is the mindset now, it's one of the reasons why I think the big sellers in Bitcoin are absolutely out of China. I think it's Bitcoin miners. I think it's family offices that are in mining. I think it's people that have held a lot of this stuff because I think China's cracking down on this whole situation. It's been part of it. And even though the crackdown's been happening, I don't think enough people are realizing the flow dynamic that's going to happen with stablecoins. Stablecoins allow for what I didn't see when I lived in Brazil, which is there was a black market, but it was very difficult to get your money outside the country. With stablecoins, any individual that's worried about the depreciation of the peso can take it out in a second. So we learned that with Silicon Valley Bank. I don't know why people didn't think about what could happen in Argentina. Very similar to Silicon Valley Bank, because a bank in the U.S. which took in all of this money, it was all evaporated in a matter of 48 hours. And the reason was because of the version of stablecoins, meaning it was digital money that was able to be taken out very quickly. The same thing will happen at some point with an emerging market country where someone loses, and you're going to have a run on the country, and it's going to happen at some point. And you've seen the ECB and China both publicly talk about the fact that they're worried about the dollar stablecoin situation. They don't know how to handle it. China wants their own CBDC. They want their own digital yuan. But the problem is, I think for these countries, it's going to be an issue. So that's the reason why I think Argentina was an interesting test case. He won. It didn't go out. But you give money to get the votes, and if it doesn't happen, the money's going to come right back into America.
Yeah, there's obviously a geopolitics game that finally is getting played in South America, which is like, we need all of this as part of our center of sphere of influence. The other thing that's interesting, because we were talking about Circle and its IPO and the network effects, stablecoins are now network effects on the US dollar. You've made it a digital network layer, which can be built on instantaneously at scale by anybody permissionlessly.
All this ultimately funnels back to Bitcoin. As stablecoins pull global capital into digital rails and AI-driven productivity reshapes the economy, Bitcoin stands to benefit from the same network effects. The forced selling that weighed on prices is fading, liquidity is turning, and the infrastructure of digital dollars continues to expand. In a world where money moves without borders and financial power shifts from institutions to networks, Bitcoin becomes the neutral asset sitting at the center of it. The next phase isn't just speculation, it's integration into a rapidly transforming global financial system. If stablecoins become the dominant global payment network and digital dollars flow freely across borders, does Bitcoin ultimately become a settlement layer for the system, or does it evolve into something entirely different? So, stay tuned for clear, data-driven insights into the financial system. Don't forget to like and subscribe so you never miss our weekly updates. Thank you for your continued support, and we hope you enjoy the video.